So for those of you who don't know me, my name is Mark Morazzo. I work with United Mortgage. I have a team over here. All we do is mortgages. So that's what we're going to be doing today. We're going to be teaching you almost the 101, the 101s of mortgages, the basics, okay? And for those of you who, you may know some of this already, but some of it you may not know. So it's important that, you know, if you know it, it'll brush up on your basics. If you don't know it, it's going to make you more well-rounded, okay? So that's the main concept here. The whole premise here is to make you guys a little bit more well-rounded, more educated. If you have, the more education that you have, clearly you'll have a leg up on all of your competition, right? So with that being said, yeah, Pete said if you have any questions, just put it in the chat box on the right-hand side. I'll try and address it as they come up. If they don't, I'll address it at the end, okay? And yeah, other than that, I'm going to share my screen in a second. Bear with me. Okay. So, can everybody see my screen? Pete, are you muted? You can see it?
I see it. You're good.
Perfect. Okay. So, like I said, this is, you know, Financing 101. We're going to have more in-depth kind of classes a little bit later. We're going to have intermediate. We're going to have advanced. But again, if we get back to basics and we know this stuff, you have a real leg up on most people out there. Okay. So with that being said, let's start it up. All right, so this is a little cheat sheet. It's a Lonopoly form is what I call it for my clients, okay? And I could give you guys this. I could print them out in high gloss and you guys could give them to your clients. And my clients put them on the refrigerator, and as they go along, they check them off as they get from process to process, step to step, okay? So number one, pre-qualify, right? So we're gonna go ahead, the client is gonna send us documents. This is when you guys send over the person, we schedule an appointment with them, we take down some personal information, they submit their documents, you know, tax returns, W-2s, pay stubs, what have you. And then we, you know, pre-approve them or pre-qualify. It says it's really pre-approved when we have documents, which we'll get into a little bit later, okay? And at that point, I issue a pre-approval letter, which a lot of you have already been in the mix. You know what that's all about. So then you guys go ahead, number two, you're going to go ahead and find the home for them. You know, this could take anywhere from a couple days to a couple years, right? I'm sure all of you guys are aware. So now what's going to happen is once you make the offer and you get an accepted offer, we're going to go ahead and schedule an inspection. And that inspection is different than an appraisal, right? So the inspection goes ahead and checks for structural stuff going on, making sure that the house is, for lack of a better term, structurally sound, right? And it's really great because it helps out with number four, which is going to go ahead and it acts as almost like a negotiation tool for the contract, right? Now, obviously in this market, as we all know, there's not a whole lot of negotiations going on, right? But normally, because obviously the lack of inventory and buyers are just kind of, it's a seller's market, right? So buyers are just kind of have their wrists tied. But if there is stuff in the inspection, you could go ahead and you know, put it in the contract, and hopefully the sellers will take care of it. And if not, if they give pushback, we may have to eat it because there's somebody right behind them these days that are going to probably look the other way because of how, you know, non-abundant houses are out there, right? So it helps for negotiations for contract purposes. Now, contracts, a lot of people, especially starting out, a lot of people don't know how the contracts are signed or who does what. You know we have a buyer's attorney, right, that acts for the buyer. We know that we have a seller's attorney that acts for the seller. But the seller's attorney is the one who drafts the contracts, right? So once you send your offer over to them, the seller's attorney sends it to the buyer's attorney, and then the buyer's attorney, the buyers would sign first, make any changes that they want to the contract, give their down payment at that point, and then send it back to the seller's side for them to fully execute the contract, right? And if they fully execute, if they sign on their side, then it's bound and it's good to go. And that is when I take over. Okay, so from number 1 to number 4, I may not hear from anybody, or number 1 to number 3, I may not hear from you guys or clients for months, right? But as soon as we get contracts, that's when my team and that's when we rock and roll, okay? So the mortgage application process is when we start putting everything together, we get updated documents, we send everything to the processing team, which works underneath me. They get updated documents, they order verifications of employment with their employers. Sometimes we need that up front, but that's a whole nother issue. God forbid we're really tight on a file. I won't issue a pre-approval, which is number 1, until I have everything really ascertained, really locked down, okay? But processing does their job. After that, we order the appraisal. You guys are aware, I go ahead and put you guys as the contact. I always put the buyer's agent or the selling agent as the contact. So you guys are in the loop, because you have to go through the listing agent to go ahead and set up the appraisal unless there's a lockbox, right? So we order the appraisal. Appraisals are taking a tremendous amount of time to come back these days. It's usually I've seen them, a week and a half, 2 weeks. I've seen them out 3 weeks a couple months ago. So it's just the nature of the beast right now. It's something that we have to deal with. But other than that, we're ordering the appraisal right after they sign our documents, which is step 5. Okay, so that usually comes out within a couple of days. Then it goes to underwriting. Underwriting usually takes about, I'd say these days, typically about a week. Okay, banks were really backed up before. I don't know if you guys have seen, but we're back down to roughly 5 business days, which is great, to get what is called number 9, which is your conditional loan approval, okay? So your conditional loan approval is your commitment, your buyer's commitment. Now, this is the thing. I get this from seasoned agents all the time. I say, hey, their loan is approved, and they're like, well, do we have the commitment? So it's very important when a mortgage professional says, hey guys, we have a loan approval. It goes hand in hand for a commitment. A commitment is a loan approval. Now, it's conditionally approved. What that means is it's not a final commitment, okay? It is basically saying, hey, listen, we're willing to do your loan. The bank is willing to do your loan, but we have to satisfy the following conditions. And those conditions could be, A, B, C, D, E, F, G, updated pay stubs, updated, show where the down payment came from, all this stuff that we're clearing on the back end, which usually takes a significant amount of time from then to the closing, okay? So, the underwriters can ask for just about anything that they want, but we've been doing this long enough where we know exactly what they more than likely will be asking for. So we get a head start on it pretty much right away. And most professionals that have been doing this for a while kind of, they gear up their team to know exactly what's going to be needed. Therefore, we're not blindsided at the last minute, okay? No one wants to, wait until the last minute and have an underwriter come back with 3 or 4 things when we're trying to close the following week, right? It's just not conducive to a business model. And it's just really, really important that we try and get a leg up on things from the get-go, okay? Appraisal received, obviously it comes back. We see what happens with that. Sometimes you guys have may seen the values sometimes come in low. Sometimes they come in high, right? Which doesn't necessarily benefit the borrowers for the most part. But when an appraisal comes in low, we have to go back to the attorneys. We have to either renegotiate or the borrowers have to bring more money down. So there's all different types of things that are going to be kind of happening from that. There's also another thing that happens, which, you know, unfortunately, maybe you guys have seen, the call for final inspections, right? So you see this more prevalent on FHA loans, but you know, they may ask for handrails. That's a really, that's one that's just, it happens all the time, right? Handrails are needed to be installed. So the seller has to do it. The seller has to implement that, and then they have to get the appraiser back out, okay? So final inspections for safety and hazard issues. Sometimes the electrical panel is off, like an electrical, you know, the breaker box. That's a safety and hazard issue. So if you see these things come up, it's normal and it should be addressed right away, but sometimes, you know, we have to wait till the last minute. Bear with me one second, actually, yes. All right, so that's the appraisal, right? Title report. I don't know if any of you lucky people have went ahead and had any title issues yet, okay? Title issues is my favorite because unfortunately we don't have control over this, right? You guys have control over submitting an offer, right? You have control over your buyers. I have control over the clients. I have control over the mortgage process from underwriting and a bank standpoint, but title, this is a third party that we don't know what's going to come back when a title report is pulled, okay? So title issues could come up. You could have open permits for work that was supposed to be done, okay? That has to be either closed out or the work has to be done, and then, you know, we have to proceed from there. You have CO issues. Sometimes a house doesn't have a CO in its entirety, which we just ran into one of those recently. But you know, there may be no CO issues for you know, an extension, a dormer, converting living space from, like, you know, you see this a lot, a garage being converted into living space, right? So all these things could show up in the title report and it could pose an issue at some point down the road. And unfortunately, as you can see, this happens at number 11. So this is like midway throughout the process, this title is coming in, right? So when we find out about this, the attorneys have to immediately attack this because it could jeopardize a few things. It could jeopardize closing in its entirety, or it could jeopardize rate lock, where the borrowers have to, you know, incur more rate lock extensions, which we're going to get to in a second. But yeah, title is one thing that you usually see that sometimes will prevent or hinder closing from closing on time. Okay, so just be privy to that. And I will say that we'll have another follow-up webinar that will address title and more of in a better approach. But I just want to give you the basics for now. And if you guys have any questions about title or anything that comes up, you could obviously you could ask me, and I'll give you my insight to it. Okay. So homeowners insurance. Homeowners insurance is usually done towards the end. We start binding that up. The borrowers have to go ahead and start shopping for policies and getting it in place. So that also happens at, you know, at this juncture, kind of at this time frame. Rate lock. A lot of your clients are always going to ask you, hey, do you know what the rates are? Do you know, what is the current rate for a 30-year fixed? Although you guys aren't licensed loan professionals, nor should you be really giving that information away, because you don't know their case, right? You don't know exactly what, their credit and their LTV and all this different stuff that goes in the rate lock. At least if you have a mortgage professional, you could guide them to say, hey, listen, this is the guy you could speak to. Right now, if you guys want every week or every week, the rates are pretty constant, but if something happens in the market, they go up or down significantly, I can make you aware. But the rates are at an all-time low right now. It's it's obviously the time to buy. So I don't want you to quote rates, but I'm sure you see it on the news. You see the twos, right? You see the rates in the mid to upper twos. And again, if you have any questions or they have any questions, you could point them in my direction. Okay. So from number 9 to number 14, this is when we're working on clearing all those conditions from the underwriter. So that conditional loan approval came out with all these different things that we have to touch on and we have to give to the underwriter. So between number 9 and number 14, we're simultaneously doing 10, 11, 12, 13, but we're clearing conditions to get what we call the clear to close, which I know you guys know about, right? These are the big words. These are the words that everybody wants to hear, because at that point, we do not need to do anything else to the file, okay? Normally it gets shut at that point, and then from 14 to 17, it goes super, super quick, okay? So once we give the clear to close, unless people aren't ready to close for a long time, sometimes things get outdated. Sometimes things such as pay stubs or bank statements or even credit reports, which really could throw a loop in the mix, those have to be updated. So once we get the clear to close, we really want to get the file on the books as quickly as possible, because again, you don't want me to have to re-pull someone's credit and their credit score goes down and then the deal dies. It's happened, and I'm looking for wood to knock on right now. There's none in my sight, but I will say that it's super, super important to try and get it scheduled as quickly as possible. And sometimes it's not in your control. Sometimes the sellers are away. Sometimes they have to, they're buying on their end. So it's like a contingent transaction, right? So just keep that in mind. And number 15, 16, 17, we schedule the closing. It sometimes takes a while for everybody to get on the same page because there's multiple parties involved, right? We have seller's attorney, buyer's attorney, title company, bank attorney, and then we have, me and you guys just hanging out in the back, just, having a couple laughs. But then the sellers, the buyers, there's a lot of parties involved. So it usually takes at least a few days to get on the books. Unless it's urgent, we could get it on the books super, super quick. But that's how that works. Final walkthrough, I'm sure you guys are familiar. You're going to do the final walkthrough. You guys know it better than I do, probably. Turning on everything, utilities, this, that, and the other. And then closing. Again, another question that a lot of buyers will have for you, and they direct them for whatever reason, right? They direct them to you guys, okay? They say, oh, we don't have our final numbers out yet. Well, the final numbers usually come out literally the day before or sometimes the day of, okay? So it's important to know or to let them know that the attorneys will give them the final numbers. It's not even me. It's the mortgage professional doesn't give the final numbers, the attorney does. They do all the adjustments they get as crazy as doing what we call, if the house has oil, they'll do an oil stick meter reading, believe it or not, right? So they'll literally stick a meter, a little stick, in the oil tank and see how many gallons are in there. And that's how precise they get to the final numbers. Unfortunately, I wish I had time to stick sticks in oil tanks and try and do final numbers. And everybody thinks that the mortgage professional is the guy that gives the final numbers. But again, it's your attorney, okay? Or their attorney, should I say. So that is, that's the process, right? That's an overall view of the process. And now that you guys have seen me kind of go ahead and explain this, and you could delve back to this because I believe this is being recorded, I could give you copies of these. You could hand them out to your clients, and it's a really good way to show that you're educating them, right? Because again, I think I've said this before, anyone could be a licensed real estate professional. Most people can pass the real estate exam, right? Most people could pass the loan officer exam if they study. Most people could pass a CPA exam. That might be a little bit more in depth, but what I mean by that is just because you have a license doesn't necessarily mean that the clientele is just going to come to you. You have to educate yourself, which will then therefore educate your clients, and you'll have one leg up on obviously your competition. And this is what this webinar and all the future webinars are going to be all about, okay? To win those deals. Very, very important, okay? So that's this slide. And I do want to just touch on a little bit about the middle here. If you ever hear your clients do this, please, please, please tell them to stop immediately and either talk to you or talk to me, or talk to someone. So you never want to have them co-sign for someone else's mortgage, okay? In the middle of the process, co-sign for someone's auto loan. You don't want to buy or lease a new car without talking to me or a mortgage professional first, okay? This one is interesting. I had to put it on. Don't quit or leave your job. I had to put that on years ago, and rightfully so. Hopefully that saved some, a couple people from not doing that. But it's vitally important. You need to keep your job throughout the process. Stop paying any of your bills. A lot of people ask, oh, can I finance furniture, right? Because they want to go ahead. They want to open up that new credit card. Please don't. Really important. I mean, if your debt to income ratio can handle it, that's great. But you guys as real estate professionals will not know if their debt to income ratio can handle it. Refer it back to me or the mortgage professional. We'll let them know. Some people, it's completely out of the question. Some people will allow it due to them making good money and not having a lot of debt, okay? Another thing is the depositing cash over $500 in your bank. So a lot of people have mattress money, right? And if you hear people, saying, oh, I have all this money stored at my house, it's not the end of the world, but there has to be a strategic game plan in place, I must say, okay? So we have to make sure that if you hear that, it is kind of I wouldn't say it's a red flag, but I would say it's a yellow flag, and it would immediately warrant attention of a loan officer who could kind of tell them how to get around it. Maybe they could get a gift from a family member or what have you. Also, disputing any accounts on the credit report. You really, really want to make sure that you don't do that. That's just an internal thing. So if they're going to do any of that and you hear that and they're like, oh, I'm doing credit repair, it's something that we want to pay attention to up front. We don't want to see them do that throughout the process. And then we have saving pay stubs, saving bank statements, continue to make all your monthly payments on time, keep all copies of your loan documents. That's very, very important because a lot of people will throw their stuff out. Then we have to wait. Sometimes people aren't savvy online, okay? So, it's best if they can do that. So if you hear any of this stuff, you're just going to think like, oh my God, Mark said that in the webinar. Let me see what he has to say. You could consult me. You could talk to me before you talk to the client, but I'll give you the insight. Okay. So this is that slide, and we'll move on to the next one. If you guys need copies of this, email me after, put it in the chat. I could drop them off at the office. I'm sure we could just keep a stack there for anyone who wants them. And I might even be able to co-brand them for you guys. So that would be pretty cool. I think that would be pretty nice little thing going on there. All right, so what is a mortgage, okay? So everybody always says, oh, I have to pay my mortgage this month. This is my mortgage amount monthly is this. A mortgage is actually, it's different than a note. A note is where you promise to pay that money back, and then it gives you your amount that you have to pay monthly, okay? So a mortgage is a pledge to pay that note. So basically, it's like you're stating this is a lien against the property. Okay, it's a lien on the property. The promise to pay is the note. So on title, and we'll go into this a little bit further later, but on title, there's a mortgage recorded. It doesn't have a payment. it's a mortgage and it's either open or it has to be satisfied, okay? A lot of people get it convoluted like, all right, my mortgage statement has my monthly payment on it, so that's my mortgage monthly amount. It's gotten twisted over the years, but it's actually, that's how much your mortgage amount monthly is, but it's not what an actual mortgage is. So if you know that, you have a leg up on probably 90% of like even people in the business, in the mortgage business, okay? So it's actually, again, it's pledging, it's a pledge to the property or security. It's a security measure for the note, okay? So that's basically what a mortgage is. Now, you may want to ask yourself what we evaluate or how do we qualify people on a mortgage, okay? And again, these are basics. You may know some of this stuff, but credit scores, obviously, we have all different types of programs, okay? Credit scores, their history, employment history. Normally, we need to document a 2-year work history, okay? So 2 years is what we're really looking for. Now, keep in mind, if somebody is in school, right? Let's say somebody, I just had somebody today, for instance, they just graduated nursing school. They were in school for 2 years. I can use that towards the 2-year work history, and they only just started a month ago, okay, at their job. So I can use that as, you know, whatever it is, 23 months of schooling and 1 month of job history, okay? So they don't necessarily have to be at their job for 24 months, or you could string together a history of jobs. So you don't necessarily have to be at one job for 24 months. You know, a lot of people get that misconstrued, okay? Assets, we have programs which we're going to get into in a second, as little as 3% down. There's actually some as little as 0% down if you qualify. Yeah, we'll delve on that in the next slide. But yeah, we need assets to cover down payment, closing costs, okay? And these could come from any which way. These could come from, you know, a lot of people, first-time home buyers especially, they don't have the money saved up, right? So they will sometimes borrow from 401ks, 403bs, deferred comp plans, and they'll pay themselves the money back. So it's a really great way to get in a house if they don't have the money kind of readily available, okay? And debt to income ratios, this is a big one. I mean, what a debt to income ratio is it's all of your monthly debt versus all of your monthly income. So if you make, let's say, $100,000 a year, okay? That's $8,333 a month, okay? I know that just because most people make around 10,000. I know that number. 8,333, right? So, so what happens at that point? Their debt to income, we have the income situated, 8,333 monthly, right? Then the debt, what's going to happen is we include everything from their credit report. So all their monthly minimum payments, such as all their credit cards, all their student loans, if they have car payments, right? You know, anything else that's reporting on their credit, and their new mortgage payment. So if their mortgage payment is, let's say, for instance, $2,000, it's going to be total $2,000, and all of the rest of their debt is $1,000 on their credit report. That means that they have $3,000, okay, and that is $3,000 worth of debt, and 8,333 is their monthly income, right? So they have a 36% debt to income ratio, okay? You basically just take all their debt, divide it into their income, and that's what they're at. Normally, you want to stay below 50%, okay? On most programs. Some are a little bit more stricter than others, some are a little bit more lax than others, but that's a really good understanding of what a debt to income ratio is. So if you hear that term being thrown around, you know it's all of their monthly debt versus all of their monthly income. You divide one into the other, and you want to typically be around 50. If you're in the 60, 70, 80 range, good night. No good. All right. So, but 50, FHA goes as high as 56. So we could go ahead and do that. Conventional, sometimes you'll be at 45, maybe less sometimes. So in that ballpark, okay? So that's how we kind of qualify. Those are the four main components of how we qualify people for a mortgage, okay? Now, are there special mortgages for first-time home buyers? Okay, so there are a good amount to choose from, and it depends if you qualify. So the first and foremost that you hear a lot, federal housing, the FHA, and what happens is with FHA, they can do as little as 3.5% down, okay? What's gonna happen is they could do a 6% seller's concession, which is amazing, okay? Seller's concessions we're going to get into in the next slide, but FHA, you'll be able to do 3.5% down, and on a $500,000 house, what is that, 17.5 if I'm not mistaken, and then all their closing costs maybe another 20,000 or something like that. So in and out, they could buy a house for $35,000, like done, okay? So that is FHA. And also, I do want to say there's a common misconception about FHA. A lot of people think you have to be a first-time home buyer for FHA, okay? FHA, you just have to make it your principal residence, and you can't really have, you have to live there. So basically, you could have had an FHA loan 10 years ago. This is really, really important. If you had an FHA loan 10 years ago and you sold it, okay, what's going to happen is you can get another FHA loan and you could take advantage of this. You also, believe it or not, can have 2 FHA mortgages, but it's really difficult. There's a lot of caveats to meet for that. So we're not going to get into that now. But if somebody says to you, hey, Mark, or whoever, we had an FHA loan, 10 years ago. Are we eligible for another FHA loan? More than likely, that would be the case. Okay. And again, there's more lax credit underwriting. It goes down. The credit scores go down all the way to 500. So that's pretty crazy, right? Somebody with a 500 credit score can get an FHA loan. Now, normally with that, they have to put 10% down. But some people with 580, 600 scores, they could do the 3.5% down, which is, it really helps out with people who maybe got themselves in a jam in the past and are trying to reestablish credit, getting back on track. So FHA is a really, really great program to get familiar with, okay? The next one is conventional. So you guys have probably heard this too. Conventional, you could do as little as, they have 3% conventional as well. Normally the 5% conventional bodes better because you have mortgage insurance anytime that you put down less than 20% down payment. That's another misconception. A lot of people say, oh, I want to take out a conventional loan, but I don't have 20%, right? Well, you don't need 20% for a conventional mortgage. A conventional mortgage, you could do 3%, and the better credit score that you have, right, the better deal that you're going to get. So FHA is primarily made for people with moderate credit, or people with good credit that just don't have the income. And the conventional product is made for people that have the income, okay, and have the credit. You're normally going to get a better deal conventional than you are FHA if you have all of your ducks in a row, all right? So that is the conventional. All right, let's go to the next. USDA. USDA, you guys are probably not going to partake in much. So it's an agricultural loan, okay? It's a government loan, and it's made more for rural rural areas that have farmland and stuff like that. You may see this on like Eastern Long Island. I know you guys do mostly Suffolk and Nassau. You may see it very, very far out east, and you have to look the property up to see if they're eligible for this particular program, USDA. If they are, what really is cool about it, it has to be your primary residence, but they could do 0% down, okay? Which is like, it's something else. We don't do we do a handful of them. I do Pennsylvania loans. I do upstate New York loans where they do qualify the the area that they're in, they qualify. But yeah, it's obviously, if you could take advantage of it, it's great. I will say there is kind of a double-edged sword there, right? If you're doing a USDA loan for 0% down, don't the sellers probably want something on contract? Like, I mean, they're probably going to want something, right? Like, they want skin in the game. So if you go to a seller, if you come to me and you're like, hey, I want to do 100% financing in this market, I'm probably going to be like, where's the other offer that's doing 20% down, right? So it's kind of a double-edged sword in that manner. And I will say that, it's not utilized very frequently, the 0%, nor the USDA in general, because it's not in the demographic that we work in, right? So that's USDA. Next one is 203K. This is an interesting one. If you guys have heard of 203K, this is an FHA program, and this is more so, it's utilized for rehab. So if you have a borrower that wants to do upgrades to the house, and we could get into the different types of upgrades. There's 2 different types of 203Ks, and there's actually a conventional rehab program as well that will allow for you to go ahead and build in these costs, right? Whether it be upgrading my kitchen, doing an extension, finishing the basement, a number of different things. I could send you guys out a list that that you can incorporate into the loan, and they basically just take out a higher loan amount and finance it, okay? These types of loans are a little bit more difficult. I gotta be honest with you. We don't do a whole lot of them. We probably do maybe, 5 a quarter or something like that, 3 to 5 a quarter. And right now they actually a lot of the investors just went ahead and discontinued them. And it's mostly because of the rates and the market is just so saturated with regular loans, right? Regular refinances and purchases. The 203Ks have a lot of more, they're a lot more intricate. They have a lot more work that needs to be done to them. And that creates a need for more staff. And just a lot of the investors are just kind of turning their nose away from them, okay? So, but they are out there, and if somebody needs it, we could try and place them a home for it, okay? Next one is my favorite, okay? So anytime you hear that a borrower is going to be using a VA loan, so they've been in the military and they have the VA benefits allowable to go ahead and take out a VA mortgage. A couple highlights of this are as follows. Number one, it's just like the USDA where you could put down 0%, okay? So 0% for VA, and there's no mortgage insurance. So normally when you take out a conventional loan and you put down 3%, 5%, 10%, what's going to happen is you pay mortgage insurance monthly, which we're going to get into in a second. But VA, literally 0% down, no mortgage insurance monthly, and the rates are really, really attractive. So, anytime you hear that, tell them, yeah, call Mark, call your mortgage professional, and just really get in the door, okay? Get that VA loan solidified, all right? All right, so the next slide, what is private mortgage insurance? So this is actually leading me up to, what we just spoke about, where VA doesn't have it, conventional does. FHA has mortgage insurance when you're putting down, just about anything, but we'll get into that another time. But yeah, FHA always carries mortgage insurance. So down payment less than 20% for a conventional file, you're always going to incur mortgage insurance. The less you put down, guys, right? The less you put down, the more mortgage insurance monthly that you're going to have. Very, very important, okay? You put down 15%, your mortgage insurance might just be a little bit a month. You put down 5% or 3%, you're going to see that mortgage insurance stacks up to $250, $300 a month. It's really, it gets crazy. And you may wonder, oh, that's cool, I have insurance, right? No, it's not cool. It's actually, it's insurance to the lender, right? So what that means is when you have homeowners insurance, it protects you. It protects you from a tree falling on your house. It protects you from someone slipping and falling, right? But when you have private mortgage insurance, it protects the lender. You're paying this premium to the lender because it's such a risky loan of you going ahead and not putting down a whole lot of money, right? So they just take this money. They take it, they take it, they take it. And it may be tax deductible depending on your tax bracket and all of that. You'll have to talk to your accountant about that. But overall, it's money out the door, and it's not the worst thing in the world if it's going to get you into a house. But if you have the 20% to put down, a lot of people like to do that to avoid this. Okay. Next. Yeah, FHA, USDA, VA have it also. FHA, VA doesn't have the monthly mortgage insurance, okay? It actually has an upfront mortgage insurance. It's just like an extra closing cost. So the monthly mortgage insurance, it doesn't have it, just like I said before. There's a little extra closing cost to be had. FHA always has it. USDA normally always has it. And when does it end? People are like, well, you know, when is this just going to come off? Because I can't pay this $200-300, you know, every however long, you know, it's just not conducive. So it sometimes comes off, normally on a single family house, it'll come off at 78% of your loan to value, okay? So what that means is once you pay down and you have 22% equity in your house, it'll go bye-bye, it's gone, all right? And it's different for investment properties. It's different if it's a two-family house, but it's important to understand that there is a chart and it will eventually come off, but just for purposes of knowing when a regular single-family primary residence comes off, it comes off when you pay down 22% equity. So for instance, if you put down 5% on a purchase, you still have, what is that, 17% to go. So you still have to pay. That could take years. It could take, normally that on a 5% down payment program, it takes anywhere from 10 to 11 years, okay, for it to come off. There is another way of getting around that, but you know, getting an independent appraisal, which we'll get into a little bit later. I don't want to bombard you guys with too much information right now, but you know, you can request it to come off if the house appreciates a bunch. You do a bunch of work to the house. You have a tremendous new appraised value, so you have a big equity stake in your house. You could sometimes get it off that way. Next, what's included in your monthly mortgage payment? All right, so we got principal, we know that, right? We got interest, boom. We have, you know, this goes and starts knocking down your mortgage balance. You'll see every month. You have real estate taxes if you decide to include them, okay? You have homeowners insurance if you decide to include it. You could waive escrow as well. You could decide, hey, I don't want that for certain programs, but that's something you have to put a certain amount down, and you know, it's not, you can't do that on FHA, you can't do it on VA, you could do it only on conventional if you put down more than 10% normally, okay? And mortgage insurance. These are normally the 5 things that make up your mortgage payment, okay? Then if you have a condo, you have homeowners association dues too, but that's separate from this, separate from your mortgage payment. Next. What is a pre-qualification and what is a pre-approval, right? So a lot of people ask this, and it's kind of, it's interesting because a pre-approval will go ahead, and that's when we collect all of your documents. That's when we know, all right, we ran your credit, we have all of your documents, and that is what a pre-approval is. Lender collects and reviews your needed paperwork, right? Pre-qual is those stuff that you get in the mail. You get these, these types of gimmicks or mailing correspondence and advertisements in the mail, and they are, they don't take into account anything. They don't know your credit score. They don't know anything, right? So that's why you want to get your people pre-approved, and you want a certified pre-approval letter. Now, this is also super important, guys. I mean, some of my realtors and some realtors out there will show houses without a pre-approval letter, okay? They'll only usually do that if they get a really good sense that the people are kind of prone to be able to be pre-approved, right? You don't want to start taking out, and Pete will go over this a little bit more with you, but you don't want to start taking out people without a pre-approval letter, and you're just not sure about if they qualify or not, because you may be wasting your time. But on the flip side, you may have some downtime, right? Maybe you want to build a rapport with the client first, and you think that it's going to work out, and you're just going to say, hey, listen, let me go meet them the first time. Let me build a relationship. Let me get my foot in the door, and then I'm going to go ahead and then, kind of put it on them to say, hey, listen, we just need to see what you're pre-approved for. Therefore, we could go ahead and, make sure we're not wasting your time, our time, and everyone's time, right? So you could kind of gauge that yourself. And now that you guys know debt to income ratio, and you know how we qualify people, right, from the previous slides, you might be able to get a better feel for if you want to take these people out if they don't have a pre-approval, right? Super, super important. All right, next. Yeah, definitely idea of what you can afford. Perfect. And then we write the pre-approval letter for you. All right, what is a credit score? So everybody knows, okay, I have a credit score. I have 3 credit scores, 3 bureaus. I don't know if you guys know, but it's TransUnion, Equifax, Experian, okay? Now, this is also very important. A lot of people, if you take them out and they don't have a pre-approval and they're like, hey, listen, I have an 800 credit score and I'm going to be perfect. My income's great, whatever. I get this, I would say on a daily basis. People tell me what their credit score is, right? But there is a different modeling system that a lending institution uses rather than when they self-inquire, okay? So when they self-inquire, that is normally a different algorithm that they use, a different FICO modeling method, and that is going to give, normally I see it be a lower score. So if they say they have an 800, it might actually be as low as a set in the low 7s, okay? So it's super important to understand that they have to come to us. They have to come to the lending institution, right? They have to make sure that we are on the same page and we have that credit score pulled, all right? Let's see what else we got here. More about what the credit score is. So if you guys see at the bottom of this page, a lot of people don't know what a credit score is made up of. So these are the 5 things that the credit score is made up of, okay? You have your payment history. If you make on-time payments, right, that's 35% of your score. So that's crucial. It's the biggest bulk of what your credit score is made up of. The second is the amounts owed. You do not want to go ahead, okay, and have a debt to high credit ratio that's too high. If you owe $1,000 on a $1,000 high credit limit, you're going to get penalized every single month for that, okay? So, you want to normally keep it below 30%. So if you have a $10,000 high credit limit, you want to go ahead and you want to keep it below $3,000, okay? That's how you get the most points for your score in that particular instance on that on the amounts owed, okay? Length of credit history, the longer that you have credit open and it's in good standing, that's 15%. Inquiries, they keep checking their credit too much, they're going to really hinder their score. And the more inquiries they go to me, they go to another guy, they're shopping for a car loan, right? This is going to be an issue. This is not, it's going to knock their score down a little bit. Then types of credit use. You want to have a good mixture of credit. So you want to have like your auto loans, you want to have student loans, credit cards, a mortgage. You don't want to just have maybe a couple of credit cards. That's where you're not going to get the most points, okay? You're going to get the most solid and most, should I say, compact score where it's not going to deviate and fluctuate too much if you have a number of different accounts open, okay? So we got that. All right, fees when buying a house. We could roll through this one pretty quick. There's closing costs, there's, lender charges, we have, processing, underwriting charges, appraisal, depending on what it is, credit report, title charges. Title charges consist of most of the closing costs, which, believe it or not, people think that the bank has control over all of the closing costs. That's not the case at all, okay? Legal recording costs to record the deed, attorney fees, all this stuff in Suffolk, Nassau. I mean, on a $400,000 or $500,000 house, you're at 20 grand, like in and out, with the prepaid costs over here, which is property taxes and insurance that is it's pretty much going to, prepay some of their taxes and insurance, even if they include it in their mortgage. We have to jumpstart their account. So with both of these things right here, we're talking, 20 grand, $15,000 to $20,000 on something in that range, 400, 500, 10,000 in taxes. So, yeah, that's that. Discount points. A lot of people ask, oh, is the lender charging points, right? I don't know if you guys have ever heard that before. So points are something that is going to go ahead and reduce their interest rate. You could buy points down. I could buy a rate down right now to, in the low 2s or in the high 1s or something, but you're going to pay a lot of money for that. It might be 3 percentage points of the loan amount. We're speaking, thousands and thousands of dollars. It makes sense if you're going to go ahead and stay there for a significant amount of time, right? So if you're not going to be there for a long time, let's say you buy your rate down and you spend $10,000 to get a rate from 3% to 2%, and then you sell the very next day, right? I mean, what good did you do? You didn't take advantage of that low rate for X amount of time. So yeah, really important that if you guys hear, oh, I'm thinking about buying discount points, now all right, well, to ask the relevant questions. How long are you going to be there? Oh, it might not make sense. You know what? You might want to speak to my mortgage professional about it. He'll give you the insight as to what's going on, but at least the verbiage, the terminology, and therefore you could go ahead and educate your clients. Again, it's all about education, right? So the more you know. So yeah, it allows you to lower your interest rate by paying up front. Recommended if you plan to stay in the home for a while. Again, if you don't, it's not going to be a situation you want to put yourself in. And it could be tax deductible, which is really nice. You should always speak to your accountant about that. All right, or they should speak to their accountant about that. Other things, can you get a gift? Everybody asks, who can I get a gift from? Can it be from this person? Can it be from a friend? Well, I am here to tell you that you can get a gift, yes, right? And it should be either a family member, a significant other. We have to document it. For FHA and conventional, it's a little bit different. FHA is a little bit more lenient with someone with closely defined a closely defined relative or something like that. Conventional really wants it to be a family member of some sort, blood related, fiance. But either way, there are always ways around certain things. And if it doesn't fit the bill, then there's other ways to get around it, and we can ask other family members or what have you. Okay. So gifts are always crucial. It always helps out. Locking in a rate, I'll go over this really quick. Some people like to lock in at the beginning. You're going to hear that, again, what's the rate? Can we lock in right away? Some people like to lock in right away. We personally, over here on my team, we like to wait for title to come back. Title, because remember, title, there's a lot of issues that could come up, okay? And if there's issues that come up with title, your people are going to be paying an exorbitant amount of money in rate lock extension fees. So if something happens and we're not closing for 2 months and we lock them for 30 days, well, it's going to be an issue. It definitely could be a problem. So that is something that we normally wait for title to come back, make sure that's all good. The appraisal comes back. We want to make sure that looks okay as well. So you could either float or you could be a locker, a floater or a locker, okay? You want to gamble? You like going to AC on the weekends? You like going to Vegas? You're going to be a floater, okay? So if you like to play it safe, I have a lot of clients that are like so rate sensitive. They say, oh my God, if it goes up 1/8 of a point, which is $20 a month, I don't know if we can afford this house, right? And rightfully so, if their budget calls for that and they know their finances better than us. Some may be a little dramatic, right? And then others may have a leg to stand on, and we don't know, so we can't presume to know everything about them. Although we could probably be intuitive to see if they're that type of person. But I will say that some people like to take risks, others don't. Floater, locker, right? Perfect. What is LTV? So this is very basic. Some of you guys probably already know this, but I'll just reiterate. What's going to happen here is you have a $100,000 house, right? You put down $15,000. You're at 85 LTV. You're basically just dividing the sales price or the value of the property divided by the mortgage amount, and then you get your loan to value. So same thing, if you put $5,000 down, which would be 5% on a $100,000 house, you're at 95 LTV, right? The higher the LTV, the more risky the loan. Also, the more that you probably will not go ahead and beat out other offers that have lower LTVs, right? LTV and down payment, inverse relationship. You have a 20% down payment, you have an 80 LTV loan, okay? So that's basically how that works. What is an escrow account? It's funny, I have clients that still say this. I get it once every couple of weeks. They call escrow escarole. Pretty sure that's an Italian dish, right? So yeah, so what's gonna happen is escrow account is you break up the annual taxes and insurance cost into the monthly payment. So instead of them coming with a lump sum, and Suffolk County does, obviously you may know, they're due in December and May. So if you do not go ahead and you don't escrow, and you waive escrow, you have to go down to the county and you have to pay, or the town should I say, and you have to pay your taxes twice a year and your insurance once a year. If you include it in your monthly payment, your payment is much higher, but you'll never have to come out of pocket this big lump sum, okay? And most people like to escrow because they like to know, what they're paying monthly, and that, they don't have $5,000 every twice a year to pay. So they kind of like to just know what they're paying all the time. You may get people who are, you may get people who are self-employed or have bonus or commission income, right? Look at us. We're pretty much strictly on commission income, right? So you guys may want to walk into a deal and say, hey, listen, I need my payment to be just my mortgage payment, my principal and my interest, right? Every month. And then when the taxes come due, I'm just going to pay them. So that is something that I see a lot of realtors do, a lot of loan officers, people in, high commission jobs. And that's something that, those types of people do. People on salaries, they want to know, all right, my payment is this for the duration of time, and they never have to worry about it again. Set it and forget it, right? Prevents any lapse of insurance coverage. If you pay this stuff on your own, guys, if you pay your insurance or your taxes, I'll tell you, sometimes you forget to pay your insurance lapses, some, bad things can happen, right? And then you're out of potentially, whatever the case may be. If you don't have insurance on your house and a tree falls on it, it's probably the last thing that you want to have happen, right? 2-month minimum balance. They like to keep a cushion in there, but neither here nor there. Actually, that brings us right to the end. It was exactly an hour, which is exactly what I wanted to have happen. So, yeah, I just, what are your next steps? We want to get the buyers pre-approved. We want to get pre-approvals out. Again, remember, we do not want to take people out on, not pre-approved, but if we have to, and you don't want to, rock the boat, you take them out and then you get it to either me, another mortgage professional. You want to get them pre-approved one way or another. It has to happen, okay? Especially before you make an offer, because, you could take somebody out 2-3 times and then they're just not doing their thing, and it's just going to weigh on you guys, and it's a waste of your time. So you want to try and you want to make it as efficient as possible, your time and what you do on a daily basis, right? So let me go ahead and see if we have the chat, if there's anything here. Stop share. Okay, so Pete is no longer there. Pete, are you there? Perfect.
Hello, everybody.
All right, we are wrapping up. So we're going to do some Q&A, okay?
Let me
so I'm just going to address the comments. Yes, we will definitely get you guys out copies. Yeah, it's, again, Joe, it could be really, it's a convoluted process in general, because although it follows these steps that you saw on that Loanopoly form, right? Some of these things are not in order. Like, I mean, some, like the rate lock might be in the beginning if they're very sensitive. The appraisal sometimes comes back at different times. So yeah, it does give them a general sense of what's happening, and it's really good to stay interactive with your client. Give it to them, put it on the fridge, put X's through each one as they go along, and it gives you another opportunity to go ahead and contact your buyer and build that better relationship, right? So yeah, absolutely, I'll drop them off at the office, and hopefully that helps. Yes. So that's yeah, guys, that's pretty much it for the comment section. Do you guys have, Pete, you want to unmute everybody, or if they have any questions?
Well, some have muted themselves, so if anyone has any questions, unmute yourself and say it. If not, we'll wrap up.
Any questions from anyone?
Mark, do you have any insight on interest rates going up in March?
That is a good question. So this is the deal. So for foresight with interest rates, I don't have a crystal ball. I always preface that with all my clients, right? But we see that with the new administration, Democrats like to spend, which is neither good nor bad. It's just, it is what it is, right? So as spending and stimulus comes through and all of this, there is going to be inflation that comes with that, right? Now, inflation is bad for interest rates, all right? So what's going to happen is if inflation keeps creeping up, that means banks have to charge higher rates in order to stay in the game. So right now, inflation is it's not creeping up right now, but they have been coming up over the last about 3 weeks, a tad bit. And if it continues like this, it's going to be, it's going to raise rates, but I wouldn't be too skeptical. All of the higher beings, all of the the higher level people, the bond traders and the people who trade mortgage-backed securities, everyone is very, very, they're on the same page where rates are going to be staying low for a significant amount of time. And it's really due to the economy. So we're going to do an advanced section on this, but let me put it this way, just to give you guys some insight. It's actually really cool. So when you're watching the news, if you see something that is crippling to the economy, right, that is good for interest rates. And we actually have a funny joke in the mortgage arena, right, where we are hopeful for bad news. And it's twisted, right? It really is not, it's not great. But I will say that when we hear bad job numbers come out, right, unemployment through the roof, it comes out once a month, right? We hope for bad unemployment. You know, knock on wood, you hear wars, you hear things of that nature. We don't hope for that. If it happens, it happens. But I will say that these things play into rates. And the reason why is this, very simply put, you have the equity market, which is the stock market, right? And then you have the mortgage market, which is closely tied to bonds, okay? Bonds are a safe investment. And the equity market, the stock market, when it's bullish, you know, people think that the economy's roaring, right? So when something bad happens in the economy, everybody takes their money from the stock market and they put it into the safer play, which is the bond market. You don't get as much money for your return or anything like that. But in essence, what it does is when they put it into the bond market, it drives the yields, also known as the rates, down, okay? So the next time I want you guys, the next time that you're listening to the news and you hear unemployment numbers or something bad happening that is just, it's detrimental, right? I want you guys to call me and I want you to ask me how the rates are doing and I'll show you a graph and you'll see exactly what I'm speaking of. But back to your point, Joe, I will say that over 2021, we are going to be super, super busy with real estate. The inventory is staying low, it seems. Rates are staying low, which means that the affordability index is what we call it, right? The rates are going down, but the houses are going up, okay? So it's still kind of equaling out. So as long as the rates stay low and the houses still stay kind of moderately priced, this is like a perfect storm for you know, a big housing market type of buy situation, okay? But then again, conversely, if the rates start creeping up, the prices are either going to have to come down to meet that affordability index where people can afford these payments, or you know, something has to give at that point. Okay.
Right.
So yeah, 2021 is going to be big, guys. You're doing, you know, you're on the right track. If you're educating yourself with this, you're out there meeting people. This is it's going to be an unprecedented year, and we're going to continue to see rates be pretty low with little peaks and valleys throughout. Okay. So I'll keep you guys informed if I hear anything else, but yeah, everybody in the mortgage industry and the real estate industry, the top level guys that I follow, we're all pretty stoked. It's good stuff, yeah.
Anyone else have any question?
Pete, you said something?
I just want to know if anyone else has any questions.
Yeah.
Going once, going twice. All right, that's the game.
All right. Well, it was a pleasure to help you guys out. Anyone who's going to be watching this on replay, we were recording, right, Pete?
We are, yes. I hit record.
I didn't want to have to do it again tomorrow. But yeah, anyone who needs this, who's watching this and wants to brush up, whether you are a beginner, an intermediate, an advanced, maybe you take something from this. And if you have any questions, any concerns, I will be here. And yeah, I hope to catch you guys on the next one. The next one's going to go a little bit more in depth. So as long as you follow this one, the next one should be a little bit more juicy. Okay.
All right. Yeah. And anyone can reach out to Mark with any other questions.
Yes. Contact info is right there, guys.
All right. Thanks, everybody.
All right,
Thank
guys.
you.
Thank you.
Bye-bye.
All right. See you.